Welcome back to a new series of PI World's Sell It to the City, and I'm your host Tamsin Freeman, and we're recording this on the 6th of October 2022. And I'm delighted to be joined by a much younger group of investors, all university undergraduates, two of whom are involved with their university's investment fund or society. And they're going to pitch their best stock idea to our leading fund managers, Andy Brough from Schroders, Judith MacKenzie from Downing, and Stephen English from Stellar Asset Management. Welcome back to the three of you. So the idea is for our investors to uncover a hidden gem that the fund managers have overlooked. So in order of presenting, I'm going to introduce our young investors, and we've got Ralph Atkinson, chairman of the Twikker fund from Sheffield University. Welcome, Ralph. And Kai Pannwitz from St Andrews University. Welcome, Kai. And Rachel Liu from Cutty, Sark Investment Society of Clare College. Welcome, Rachel. So the format, each investor has 10 minutes to present their stock, followed by 8 minutes of questions by the fund managers, who will then give their views on the stock and on the pitch. And then after the last pitch, we'll come back to the fund managers to give their scores out of 5 for both the stock and the pitch. So let's get started, and we'll go to Ralph, who'll pitch CPP, ticker CPP. Ralph, over to you.
So hi everyone, my name is Ralph, and today I'll be pitching a buy for the AIM listed equity CPP group. So I'll just dive right in. Yeah, so really quickly, how do they make money? Well, they offer a range of real-time assistance products, and these could be things like insurance for your credit cards or emergency home services and things like that. So if you get on a flight with Jet2, these are the people who help you out should your flight get disrupted or for your luggage to get lost. And they offer a range of services. So for example, they would partner with the airline and they would implement and manage the customer facing tools that would deal with, say, the baggage losses or the disruption with your flight. So very quickly again, as you can see from the past 12 months, sentiment in CPP has been really, really poor. And the company now trades at just 134 pence a share at the time of making this. Now, I don't have time to do a full sort of breakdown of all the detailed financials, so I just thought I'd pick a few metrics which I think sort of highlight and illustrate the underlying quality within the business. So considering this is a £12 million market cap, you get a business that has grown sales pretty much year on year since 2015, now to £144 million. However, earnings have been slightly spottier, but certainly with some good strides in 2021. Now EBIT represents approximately 1/3 of the total market cap. And I think what's sort of most encouraging about this slide is you can see sort of since 2016, earnings have been really highly correlated with sales. And I think this is a testament to how management are trying to grow their earnings organically rather than just through, say, a one-off cost-cutting mechanism, which has very limited scope moving forward. Also, like us, businesses are investors, and I think by looking at returns on capital, we can really examine how effective the business is at putting their capital to work. And since 2018, CPP have been improving their returns on capital year on year, now enjoying a 20% return on capital employed. And I've also included the lease adjusted version here to show that there are really very limited lease commitments within the business. And from a relative value perspective, running a quick stock screen, there are only 3 AIM listed businesses that trade below cash that have a 20% return on capital employed. Now, while it is true that CPP has very thin profit margins, I think it is encouraging to see the strides that the business has taken over the past few years. So since 2018, they've made at least some incremental improvements to their margins. And this is the best improvement the business has made to their margins over a 4-year period since 2007. And I see this as evidence of management at least starting to become more strategic over their costs and their efficiencies. And I think one example of this has been the dismantling of loss-making legacy businesses, especially in the UK. I thought it would be really interesting to see or have a look at the flows in CPP. And as you can see, the volumes are extremely low. with just a handful of orders every day and sometimes no orders. Now, while this could present a liquidity risk for a larger investor, for a retail investor like myself, I can say with confidence that we can be lemmings and we can certainly be quite foolish. And if you look at the size of the orders, a lot of the people moving in and out of the market are definitely retail traders. And as a result, when looking at these AIM-listed shares that are predominantly sort of dominated by retail traders, you get huge sort of valuation mishaps. And I think CPP is certainly no exception here. So how do you value CPP? Well, really simply, you just look at the present value of future cash flows, and then you discount those cash flows back at an interest rate. And here I've taken the interest rate to be the weighted average cost of capital. And as you can see at the bottom, it's really small. As of today, the implied value or the intrinsic value of CPP would represent over 200% upside at the current share price. So how does CPP fit into the macro? Well, naturally, with any equity investment, interest rates rising will impact valuations. However, I think this will lead investors in AIM businesses to perhaps move away from the top tier equities that have, sometimes decades of future cash flows and earnings already priced in, and in comparison to, say, a CPP, which already has a robust backdrop of earnings and a really strong cash position. Next, CPP offers exposure to emerging markets through both their Turkish and their Indian businesses. Now, while this is definitely like an exciting offering and definitely presents further revenue growth opportunities, it's really important to consider how their exposure to, say, the lira and the rupee, they are definitely party to the macro risks of these nations. For example, due to monetary policy mismanagement in Turkey, they're now suffering from, I think it's an 83% inflation. And from looking through the balance sheet, I can see that CPP don't actually hedge their FX risk through, say, cross-currency swap or a future. So that's definitely something to think about. And I guess while CPP is probably more of a nano cap than a small cap, certainly looking down the value chain, you see that the smaller companies tend to deliver outperformance. And I think, especially looking at a recessionary period that we're facing now, a lot of managers are looking to sort of de-risk from their portfolios. And I think CPP really offers limited downside risk as a business that already trades on a significant discount. And it will also flash on plenty of retail investors' screens moving forward, as they've got a 300% EPS growth forecasted in. So in terms of the risks, so should inflation continue, obviously the value of those future cash flows that I had in the DCF will be eroded and the valuation will get harmed as a result. And equally, the thin margins mean that any continued cost pressures on those commodities would eat into the earnings if they cannot keep, raising prices alongside inflation. And equally, as I mentioned, a failure to hedge out their FX risk in those volatile EM regions will also impact their returns. But of course, this could swing both ways depending on the value of the pound. And equally, while it is encouraging to see CPP pursuing a growth strategy, I think doing it through acquisitions can sometimes be potentially symptomatic of a management team that doesn't know how to pursue growth organically. But I think this is caveated by the new CEO, a man called Simon Piper, who has lots of deal experience. He's worked on over £100 million of deals in the AIM space. Also, I guess this wouldn't be an issue for a retail investor, but certainly for a larger investor, due to the lack of volume and flows, liquidity could be an issue if you wanted to move in and out of a position. And finally, and arguably the most prominent risk of a trade like this is a value trap. So it can take years for securities to reach their fair value, and there's certainly no guarantee that that's going to happen anytime soon. So as an investor into CPP, you could be sat in this position for years watching your relative returns and your absolute returns falter as a result. And I appreciate now I've actually been quite negative, but so why should we buy CPP? Well, firstly, the customer growth, I think. So CPP has over 11 million customers and has been improving sales almost year on year since 2015. And I think this is a testament to the strength of the underlying brands, but also their ability to retain revenues from new customers. And furthermore, when looking at their Indian business, their revenues are nicely diversified across their 4 key services. And next, with such a robust balance sheet, with approximately £19.3 million in cash, but also no pension deficits or any dangerous leverage to be worried about. I think they really do have the sort of the scope and the mobility to pursue a more capex focused strategy moving forward, investing in their tech platforms. And that leads me on to the digitization. So as part of Simon Piper, the new CEO, as part of his new strategy for CPP, they are looking to become a technology-driven business. And this means introducing a digital cloud-based IT platform, which should be rolled out in Q4. And this will mean less overheads, but also less regulatory challenges, and therefore will hopefully bring better margins and better returns on their capital. So finally, I mean, don't get me wrong, there are plenty of issues with CPP, and the worry is that it might be cheap for a reason. But the margins and the free cash flow generation, they're very consistent. Their cash returns on their capital invested could certainly be better. And there is no guarantee that they'll be able to maintain their market positions in Turkey and India over the long term. And also, they've even revised down their 2022 profits. But all that said, I think that sort of fundamentally CPP is mispriced. For a £12 million market cap business to be nearly doubling its sales to 144 million in a 6-year period, alongside taking active steps to be more strategic and to pursue a more tech-focused and tech-savvy strategy through the sale of legacy businesses and also capex with new management, while making more profits than, say, like an Uber or an Airbnb. I think CPP really represents a great deep value opportunity. And moving forward with this investment, I see the catalyst for the share price being potentially some block trades from new management, as I guess a sign to the markets that they do have skin in the game, or margins hitting 5% following an announcement of their their new tech-focused platform. And I'd be happy to take any questions.
Thanks very much, Ralph. So who wants to kick off with questions?
Yeah, I'll start if you want, Tamsin. So, Ralph, yeah, it was a good pitch, actually. I mean, the thing that concerns me is that 3 people own 90% of the company. So you're looking at a free float of £1.2 million, which is going to make it quite hard for anyone to get involved. So you've done all this work for what is potentially a difficult share to actually trade in. So did you think about that before you embarked on this mission?
So I'm a retail investor, so it's not really something I need to worry about. I've got I'm in the fortunate position I can go on things like AJ Bell and Hargreaves Lansdown. But as an institutional investor, as I mentioned, liquidity is certainly an issue. But yeah, for myself, it's not one I had to think about.
So you actually bought some yourself?
No, I haven't, but I've looked at it. I've been watching it slowly deplete over 6 months.
And can you say a bit more about what their products are? Because as I understand it, the flight bit is pretty small. I thought it was more mobile phones, insurance, and they don't have, with the Indian operation, they don't really have the same stickiness to their customers that they had in their sort of legacy book.
Yeah, no, that's correct. And they've also, unfortunately, over the past 2 years, some of their retained revenues have slipped slightly. I think it's about 6% over the past 2 years. But it's a combination of things. So as you mentioned, it's the airlines, but it's also home emergency services, credit card protection, and equally things like just managing your gadgets and stuff like that, gadget insurance. But it's important to also recognise here, yes, they implement insurance products and services, but fundamentally it's not a financial institution, so they're not subject to the same, I guess, regulatory challenges that, say, an Aviva would be.
Judith, Stephen.
Yeah, I've got two areas of question. One is on their consolidated accounting, because they own 51% of the Indian business. I'd just be quite keen to understand what numbers you've used in your presentation. Is it the profit attributable to shareholders, or is it they're quite good at presenting EBITDA numbers that are the consolidated number, and there's quite a big difference?
Yeah, I mean, so was your question, which profit numbers did I take?
Yeah.
Yeah, so I took the EBIT, not the EBITDA numbers, and I downloaded those from a SharePad platform.
But is that, because they're consolidated accounts, is that the consolidated number, or is it the number that was with subsidiary accounting like this when it's consolidated? they consolidate it, but then it's only at the bottom that they show what is attributable to the UK shareholders, if you like.
Okay, I mean, yeah, that's really interesting. I couldn't give you an answer. I'd have to go and check. It's
quite a big difference. The other thing that they did that was quite exciting, I suppose, was they had a one-off provision gain that was about £1.5 million, I think, that they put back into this year. So again, that's flattered the numbers. I don't know if that's something that you'd identified or not.
No, I hadn't seen that in the numbers.
Just little things to look out for. I only know because I've been stung many times. And the other one is management. So it's been a massive revolving door, hasn't it, in the last 12 months? I think chief exec's gone, FD's gone, big payouts, about £1 million in payouts. I think the non-execs have gone as well. There was a HR woman disappeared too. Any view on the management aspect of that change and any risk associated with it?
Yeah, I mean, I think this is also one of the sort of the key issues with CPP, and it has been for a while. I think in 2016, there was certainly some negative press with CPP. They were subject to some negligence in terms of the actual products they were selling. But they took active steps immediately to sort of get rid of those, what we'd call few bad apples, and implement a brand new management team. And I think it's actually quite encouraging to see a lot of turnover, because CPP has a 30-year backdrop of brands, and without seeing the robust and optimistic strategy that the management are implementing, they will just get rid of someone who is actually going to do the job and get them back to the market position that they once had.
But there is probably a risk associated with that execution.
100%, yeah. And I guess us, part of the valuation, that is certainly a factor in why it's so cheap. But from a fundamental perspective, I mean, if you're looking at what you're paying for and what you're getting in return, it is really a tremendous value.
Stephen.
Thanks, Ralph. Enjoyed that. I bought some last year at £5 and sold some at £4.10. So don't listen to me now. What comes thereafter? Clearly useless. I did like the CEO's line recently in the results. He found a business with no adequate plan to address the decline in the legacy business. It had no sense of purpose and it had no strategy. The only thing missing was hand me 2 pencils and a pair of underpants and start wibbling. It sounds like a bit of a crisis. And on that legacy business, any idea of how much of a drag to profitability it is at the moment, the UK side, and how much it would take to exit that legacy business?
I think on their most recent accounts, it was about a £1.4 million detraction from their profits. In terms of the actual operational costs of leaving a legacy business, I think it'd be really foolish of me to try to guess that. I think these really complex business moves, and it's really too early to say. And it's not only the UK as well. They also had some German operations and Chinese operations that have sort of been wound down. But it's not just legacy ones. It's sort of any part of the business which just isn't delivering the profitability, and they are looking to just focus around the parts that sort of the hubs of the business which do have the scope to reach the margins that shareholders want to see.
Okay. I think to crack this one, whether it's value or not, because the EV/EBITDA looks like screaming value on a sub 1x level. Just go into the corner and pick that money up. On a PE basis, it's on a PE 44 times. I'm just wondering, what tax rate were you using for your NOPAT figures?
Yeah, I mean, this is actually one of the sort of flaws of my DCF model. I wasn't sure about how to sort of manage the tax things if you had earnings, in sort of multiple domiciles, multiple regions. So I just took the sort of average corporate tax rate from the regions that I was looking at. Because if I'd have taken I think it was the effective tax rate that was in the report, the WACC would have come out something that was just, it would have made the model look a bit sort of silly, and it wouldn't have been realistic.
Okay, it's a queer company, because the effective tax rate in 2020 was 135%. In 2019, it was 119%, i.e. their tax is bigger than their pre-tax profit, which is really strange. They actually had a massive upgrade to earnings per share, which is obviously an after-tax figure recently. The broker increased their forecast by 50% across the next 3 years. And that was purely because their effective tax rate forecast has been cut to a still mighty 85% from 90%. So the earnings per share is hugely sensitive to that effective tax rate, and 85%, compared to 19% UK is hugely punitive. So without being a tax expert, it's going to be very hard to know if that 85% is going to collapse to something more normalized because of this multi-jurisdiction, as you say, or whether 85% is kind of the norm and the tax man's going to do a lot better out of this stock for years than shareholders will. Do you have a view on that?
No, I mean, again, I'm equally absolutely no expert in tax, but yeah, I really couldn't say.
So I think we'll have to leave it there for questions, but let's have some feedback. Andy, do you want to kick off with your feedback? No scores at the moment, although keep a record of the scores that you're going to give, but give your feedback on the stock and on the presentation.
So, Ralph, I was very impressed with your knowledge of this stock, actually. It's always absolutely crucial, though, when you're pitching to fund managers or whoever, to find out who actually owns the shares. So in the report and accounts, you might have found that Schroders owned 10% of CPP. And I'm surprised you didn't actually sort of bring that up. But on the main, I was very impressed with your knowledge of this company and the way you portrayed it. And I thought your slides were excellent.
Thank you.
Thank you very much indeed, Andy. Judith, any feedback, both on the stock and on the pitch?
First of all, on the stock, I think, in this case, I think the numbers really need quite a lot of scrutiny because only 40% of cash is not free cash. So we'd never be able to be returned to shareholders. So your EV, EBITDA looks cheap, but it ain't that cheap. So to me, there's cash risk, there's IT risk. Always hate a big IT deployment coming over the hill. There's tax risk, talked about as well. There's definitely execution risk. I think they say that they're going to articulate their strategic plan in October at some point. So I would probably be wanting to see that before I got too excited. Currency risk, obviously. There's a bit of customer dependency, even though there's 12 or 22,000 odd underlying clients or customers, there's really quite a bit of concentration risk, especially with a big contract in India. And there's shareholder risk. As well, Andy's on the shareholder list, so there must be a lot of risk there. But there's also a Hamish Ogston that's got about 39%. Don't know who he is. I couldn't even Google him to find out. But so for me, from a stock perspective, it's probably one that I can sit back and watch for a while. I thought your presentation was good. It's not easy to describe this business. So well done doing that. And I think your overall sort of headline analysis was good. It just probably needs a little bit more delving into some of the intricacies of the financials here. You probably have chosen one of the most challenging businesses or types of business to pitch and to analyse because of the complexity of the multi-jurisdictions. But well done.
Excellent. And Stephen, your views, both on the pitch and on the stock?
Echo my esteemed colleagues on the pitch. Fair play to you, Ralph, for taking that on. As Judith said, that is some beast to try and wrap your arms around. I think bigger mission for me was the tax angle. 85% of it going to the tax man for the foreseeable future. But you touched on some really good things. I really liked your Rocky slide, albeit it was probably pre-tax. You were calculating it on. You addressed a lot of the issues, touched on the risks. You laid out a good investment case, and even touching on the CEO's background and the digitalization piece that they're trying to get to. It's kind of an analog business that's trying to transition. It can get there. It'll get a digital rating maybe at some point in the future. But for me, until that strategic review is complete in October, it's uninvestable. We don't know what the shape of the business is going to look like. Don't think the exec management team have bought a single share in the last 2 years. So if they haven't, why on earth should we? And the big change program that's going on, they've said it's going to take longer, it's going to cost more, and the upside is going to be less than the previously forecast anyway. So a bit of an unholy trinity from that side of things.
Tremendous. Thank you very much. Andy, you didn't give your view really on the stock. You said Schroders own 10%. Was that enough of a view to say you're all in and you love it?
It's been a absolute nightmare of an investment. Hamish Ogden, for Judith's information, is the founder, floated the business, could have sold the whole thing to private equity. And then the FCA changed the rules on renewability, which completely destroyed the front end of the business. And it's just been a downward spiral. Myself, Gary Channon, came in and rescued the business in old form 3p a share. God, I don't know what that is today. And so we're stuck. And so I know a lot of people trying to buy it, the PA, because they think it's cheap. But I just think that liquidity of 1.2 million until there's an event is going to not encourage Judith or Stephen to get their checkbooks out. But they know where I am if they do.
Thank you very much indeed. So we'll now go to Kai Pannwitz from St Andrews University, who's going to pitch Vector Capital, ticker VCAP. So Kai, over to you.
Thank you, Tamsin. So first of all, why am I pitching this stock? The main reason is because the stock's very cheap. The PE ratio is under 10. And I believe that the company is in a strong position and that its share price will increase. It's a profitable business with margins of roughly 40%. It operates in a niche market that is growing. It's a very small company, but it's efficient. Who are Vector Capital? They're a commercial lending group that offers secured loans to small property developers who buy properties, refurbish them, and then resell them. Loans are secured by a first charge against land or property, so that if the loanee cannot make repayments or defaults, Vector can recuperate the funds. Loans are financed by a combination of the group's own resources and its debt facilities, which I'll go on to talk about. So yesterday the share price was 48 pence. It's a microcap company at roughly 21 million pounds. Like I said, the PE ratio is under 10, and there's that high profit margin. And also 80% is held by insiders, which makes me believe that many institutions do not know about this opportunity. Not included on this slide is the 5% prospective dividend yield, which is underpinned by a half-year earnings per share of 2.8p. Some of the key performance indicators, the big one is the loan book size. So in December 2021, the loan book was 46.3 million, but in December 2020, it was only 36.4 million. So this represents an impressive 27% year-on-year growth. Other key performance indicators are the number of live loans. Again, it's increased from 2020 to 2021, and the average loan size also increased in that year. So the takeaway from this slide is that the business is growing. The key strengths of the group: they've got extensive sector experience. They've only been a public company for 2 years, but they've been doing this for 20. And a key differentiator is their ability to provide same-day decisions in principle. Few other companies have the flexibility or systems to do this sort of thing. They provide bespoke solutions on a case-by-case basis. As we'll see later in the revenue streams, they've got more than one. They've got the knowledge to undertake different sorts of challenges. They've got a custom-designed cloud-based platform, which I'll also touch on later. So how do deals originate? The first thing is that the brokers pre-assess deals before submitting them to Vector. That's the first stage. Then Vector runs anti-money laundering and credit checks. After this, 2 to 3 members of the credit committee sit down and weigh up the risk versus the reward potential of the deal. And if they believe that it's a good project, it's then passed on to solicitors to perform their due diligence. If all of those boxes or criteria are ticked, then the deal goes ahead. And in this way, Vector never deals with the customer directly. It's always solicitor to solicitor. So loan security, the big one is they take a first legal charge on property. Also, the average loan to value is such that the loanee has a lot of skin in the game, so they don't want to default on the loan. They also make loan agreements with the borrowing company, and they have directors' guarantees made when they lend to special purpose vehicles. So in this way, Vector spreads out the risk. So briefly on their loan agreement management system, this is a cloud backup of all their data. So in COVID, they weren't very affected. They could work from home very easily. It's got a very good database of borrowers, including all of their contact and loan details. They've got live payments and redemptions, and it's very good for audit purposes. They get audited 9 times a year, and they just provide an audit profile for the auditors, and that allows them to audit them quickly. So they've got a £60 million lending capacity that's made up of 3 things. 2 banking facilities, Aldermore and Shawbrook Bank Facility. So Aldermore, they get a £15 million contribution from, and 20 million from Shawbrook. So a total contribution from the banking facilities of 35 million. Last year it was only 25 million. So it's a good thing that they're increasing that. And also a £25 million contribution from shareholder funds. And they get charged at 6.5% by the banks and lend to customers at 11 to 14%. And this spread is where they make their money. So here, the biggest contribution to their income streams is the residential sector. They've also got commercial, land and development. And this one is a little bit more tricky. So that's why they prioritize residential. It's the least risky and makes them the most money. So the revenue went up 21% to 3 million. Yeah, that's from the 6 months ended 30th of June to the 30th of June 2022. Their interim dividend of 1p per share, it was 0.95p per share in June 21, which reflects a strong performance. Some case studies here. So at the top left is Sedgemoor campus. It was a large office block, and Vector provided a £1 million loan to enable a conversion to flats. Similar story with Kean Court and Stafford Park. And this gets me on to the fact that a lot of their business is with repeat customers, which is a very good sign. They operate in unregulated financing, which is different from regulated. Big banks aren't in this space. That's why I say it's niche. They're not regulated by the FCA either. So what's the strategy for Vector? They want to target a loan book of £100 million in 2 to 3 years. The CEO, Agam Jain, has been quite clear on this. And to do this, they need to maintain and build new broker relationships. So right now, they've got 6 brokers that they deal with regularly, that they get business from, but they want 12 or 13. They need to increase their debt facilities, so get more potentially from Aldermore or Shawbrook, or find another commercial lender. They're a small company, less than 10 employees, but they don't need to take any more employees on. They're happy to stick with what they've got and train them up to deal with more complex problems. So Vector aren't without risk. They rely on a sufficient supply of prospective borrowers. The value of property in England may decrease, which would impair the security of the loan book. If, for example, a loanee defaulted, Vector would have to sell a property at a lower price. Changes in regulatory environment may increase Vector's compliance costs. So if they became regulated by the FCA, and also the increasing interest rates, that's also maybe a problem. But they're a cheap proposition. They've got a strong management team with experience, and I believe they're a very good stock to invest in. Thank you.
Tremendous. Many thanks indeed, Kai. So who wants to kick off with a question?
Yeah, I mean, I hadn't heard about this little company before, I have to say, so I was quite interested to dust down the report and accounts. I think the obvious questions at the moment are about the macro, and you've addressed obviously some of the interest rate pressures that might come about. And what would you be monitoring, I suppose, going forward in that rather volatile interest rate environment? I suppose there's a couple of things. There's loan to value, isn't there? And there's the default rate as well. So what would you be looking at if you were owning the share over the next 12 months on a fairly regular basis, or as regular as you could do?
Yes, if the interest rate kept increasing, if the base rate kept increasing, and then a statement by the CEO was made that they were worried, then I would think about selling the stock or not buying. But I think right now it's at an acceptable level that I would still buy the stock.
Yeah. And one of the other things about this company, it's a bit of a minnow, really, isn't it? I think you said that yourself, and it's underneath the radar, and therefore, is it a bit of a value trap, do you think? Because the scalability is dependent on that loan book growing and the access to capital in quite a challenging macro headwind. So, what do you think the real breakout catalyst might be for this business from a share price perspective?
I think it's really good that they've got repeat business, so they've got a strong foundation there. If word spreads, if it's mouth to mouth between brokers, so that they get more brokers and more clients, and I think that will work for them. That's a catalyst.
Stephen.
Yeah, I'm not a massive fan of listed lenders. The main way you increase your profits is to increase your loan book. Nothing worse than a fast-growing lender. Anyone can lend it. It's hard getting paid back, and the worst of loans are written in the best of times, and vice versa. And there's that pressure to constantly try and increase the loan book. That said, the best lenders on the stock market are those that are family and founder-led. So you've got that bulwark against that, as you've identified with the large shareholder inside the shareholder, a bit like S&U. Just on the return on equity, price to book looks at 0.8 times. When you're at a discount on price to book, it's normally because your return on equity is below your cost of equity. Do you have a view on the current return on equity and the trajectory of that return on equity, Kai?
I'm sorry, Stephen, I haven't seen those figures, so I can't speak to that.
Okay. It's 10% at the moment, and it looks like it's going to stay 10% for the next 4 or 5 years. The only way they can get through that escape velocity is to gear the business up more. And that's what kind of puts me off. That in old school, net debt to EBITDA is 5.5 times, which is scary as hell for me as an equity investor. And they're only getting a 10% return on equity despite being geared up. They'll say they're not that geared because their debt to equity is 1 times, and they're prepared to go up to 3 times debt to equity. Whereas the listed player I own is a pawnbroker, H&T, and they can generate return on equity with no gearing whatsoever of 15%. So that's a long-winded preamble of, I note they're paying that dividend, which seems attractive. Do you think that's the right policy while they're trying to trap capital and grow that loan book? They did do a raising recently at 47p. So why pay out a dividend on the one hand and then have to raise equity at a discount to your book value on the other?
I know that the placing of new shares, I think that was always the plan. Like they mentioned this a year before they did it in 2020, that they wanted to place shares again.
Do you think it's the right policy to be paying a dividend while they're in this kind of early growth stage?
I think it makes it an attractive proposition to investors to reel them in.
Do you think it's fictitious though, or somewhat fictitious if it's not covered by free cash flow?
Potentially, yes.
Thank you,
Maybe
Kai.
Irish,
Thank you. That's the right answer. Thank you.
Thanks, Stephen. Andy?
Yeah, Kai, I think the thing that's worried, that I'll be interested in your view, is that when you read the report and accounts, they have to renew the loans, the wholesale funding with Shawbrook and Aldermore every year, and yet they're going into these big contracts to lending the money for people to develop 16 flats out of an office block. And if their builders work at the same rate as my builders, then it's going to take a lot more time than a year to finish that, and then to sell it. How worried are you that there's a big mismatch here, potentially, where they're sort of lending long and borrowing short?
So do you mean like the projects that they take will take a long time?
Yeah, because you've got to roll the loans every year, and we can see what's happening in the general economy. You could then be stuck with a load of projects that you can't sell, because actually, plus then the wholesale lenders say, actually, we'd like our money back now. So you become
That's a good point.
astute. Well, thank you.
I trust the management team to diversify between short-term and long-term projects, and also that the brokers that they deal with, they're brokers that they've dealt with for a long time, and that they'd recommend good projects for Vector.
Okay. And how concerned are you? I mean, when I kind of look at the mortgage rate tables, then people are saying, a mortgage is 5-6% a year, and yet these people are charging 12%. Doesn't that not concern you that the underlying credit quality of the people they're lending to isn't nearly as good as the likes of the people Halifax and Lloyds are lending to?
That is a concern, yes. Yes, I'll admit, but I feel like they're a good company, and they'll keep doing what they're doing and go under the radar and grow slowly.
Well, you mentioned under the radar a lot, and it's quite interesting that the three fund managers on this panel have never heard of Vector. I thought it was some sort of mathematical sort of question when I first saw it. So how did you find it?
I found it in the Investors Chronicle.
All right.
It was in Simon Thompson's bargain shares portfolio.
So I do echo what Stephen said in terms of, a small lender is quite a good way to lose money, actually.
Thanks very much, Andy. I think you've almost given your view on the share, to be honest. I mean, do you want to carry on and give your view on the share and give your view on the pitch?
Okay, yeah, it's quite interesting. The pitch is, you just need to bring it to life a bit more. You're going through, it's almost like you're taking the slides off their website and putting in a few slides from the report and accounts. The key thing is, when you're presenting, is to have like just a couple of points on each slide and bring it to life, show that, actually you've taken the numbers from the report and accounts, put them in a slightly different format to demonstrate what you're trying to say, rather than just go through it. Because, finance, I accept, is a difficult subject to do that with. And hats off to you for actually having a go with this. Personally, I would rather go by Lloyds Bank, which trades at 0.56 times book, and I've got more confidence that black horse is going to keep running a long time than Vector Capital.
Thanks very much. Judith, let's go to you and get your views on the stock and on the pitch.
Yeah, the stock, I think it would be lovely as a family-owned business that was maybe private, where you didn't need to overstretch yourself, and you could just take a little bit of a dividend out, and it was what you did, and you didn't need to grow that loan book like the market is probably demanding. So like some of the others, I've had my fingers burnt with loan providers in the past, and we stick to pawnbroking as well, Stephen. You'll be glad to hear. But we're slightly further north than you are with Ramsden's, real down to earth, nitty gritty lenders with net cash in the balance sheet of about £13 million. So that's the kind of lending that I like exposure to. The pitch, I think you definitely went through the motions, covered all the points. I think one of the things when when we as fund managers are pitching stocks to our investors, the times that you get the most engagement is when you show that you're really passionate about it. And I think, just adding a little bit of that to your presentation and really sort of showing that you believe in it it really wins hearts and minds. But good, well done. Another difficult one to take on, to be honest. So not easy.
Thanks very much indeed, Judith. And Stephen?
Yeah, agree with Judith on the private comment. There's just that inherent pressure to always put that money to work. If we go through a downturn, demand for loans may not be there, and then that return on equity just gets smashed even more. I always remember HBOS in June 2007. It deliberately reduced its share of the new mortgage lending market to 8% from 15 to 20%. Because it said the pricing was bonkers, and then the stock market rewarded it with a 4% fall in share price. So the CEO reversed ferreted pretty quickly, and then within 9 months they had to get rescued by Lloyd's. So to be a forced lender is not the place you want to be. I do like the fact there's only 8 employees in the whole organisation. Gobsmacked by that, and they can double and apparently double again from here without having to add extra resource. But until they can get out of that 10% no man's land on a return on equity, I think the rating is always going to be quite lowly, and they're always going to have to be issuing shares below book value. The pitch itself, I thought it was really, really comprehensive. Kai, you got a very soothing voice as well, perhaps too soothing for my esteemed colleagues, and you've wore a tie, which is showing us all up. So there's a level of professionalism that you've got already in your game that we lack. But I think you covered pretty much everything. That platform is a key bit for Vector as well, in terms of that quick decision making and the relationships with the brokers, which you touched on, seems to be a bit of their value add. Lending money is quite homogenous. It's hard to differentiate yourself. Some people claim to have better algorithms than others. They don't. Invariably, relationships do matter in this space. So I thought you covered a heck of a lot of ground.
Many thanks, Stephen, and well done, Kai. And I'll come back to you, Judith, Stephen, and Andy with your scores later. We'll come back now to Rachel Liu, member of the Cutty Sark Investment Society at Clare College, who'll pitch Norcros, ticker NXR.
When you try to think of the kind of racy or small cap stock that will get the world's best investors circling, a distributor of shower trays, adhesives, and bathroom and kitchen fittings isn't very likely to spring to mind. However, the London-listed Norcros, NXR, which does just this, stands out as a great pick. You may not have heard of the name Norcros, but it's quite likely that your kitchen or bathroom uses one of its products, which includes Triton showers, Merlin shower enclosures and trays, Cloydix toilet seats and vanity units, and the ceramic tiles maker by Johnson Tiles. I have not been personally involved in any of the construction work, but I do work for operations in several societies at university, which basically means I usually try to buy quality products for cheaper prices. So I did a search on the internet on adhesives, as Norcros adhesives is developed by the management team and grew organically. I have found the Norcros products very easily accessible, laid out in very clear categories. Moreover, they have skills brochures and a very active YouTube channel. Having watched a few videos, I found them very straightforward to understand. The well-maintained nature of the website and the fair pricings of the products are very attractive to me as a potential customer. And this experience ignited my interest to further explore this company. As we all know, the stocks are doing not so well lately, facing the potential rate hikes and prolonged inflation risks. The key attributes of a company that will rebound and succeed is one that has 1, the ability to pass on the cost pressures and survive, 2, long-term growth, high growth potential, and 3, a management team that is quite alert. So I will try to cover how Norcros performs exceptionally on the 3 fronts. So a good place that we can start with to try to understand Norcros is its stock price. That's because the 31% fall in the share price since the start of the year rings alarm bells. At the same time, with a forecast price to earnings ratio of less than 6, we can already see hazard lights flashing. It's the kind of rating that says market sees big problems on the horizon. Yet, I don't think we need to look far for a reason for the warning signs. The combination of input cost inflation and the prospect of a recession makes a terrible mix for a company in Norcros' line of work. Also, at 36%, gross margins are slim, which means that after-tax profits will quickly feel the pinch if cost increases cannot be passed on to customers. The risks are increased by the fact that Norcros carries high stock levels on its balance sheet, equivalent to about a quarter of its sales. In the event of a sharp downturn, it's all fodder for write-downs. Yet, the numbers also offer assurances for nervous investors. First, the company has the ability to pass on the cost pressures and survive. The first concern investors may have is that the company may be building up debt if trades are stagnated, especially since Norcros carries high stock levels. Yet, net debt is low at £50 million, which is just 0.3 times last year's EBIT. In addition to that, Norcros has boosted its EBIT by 50%, thus reducing the specter of future debt repayments. What's even more impressive is that free cash flow exceeded £9.2 million, being 105% of its EBIT. This signals further capacity by the company to manage debt and the stock levels on the balance sheet. Second, the company has long-term growth potential. Aside from the debt numbers, other financials also show significant strength. Looking beyond the current aims, the company aims to hit £600 million of sales by 2025 and is already nearly there, while keeping return on capital employed at more than 15%. The uncertain economic conditions are more important than ever, but they aren't very easy to find. Norcros has a dividend yield of 4.38% and is forecasted to grow by 2.78% in the coming year. This is a healthy dividend that shows that the company has good cash flows, yet not too high, it reduces the investments. The business model also stands well. Despite the M&A deals, the company has achieved organic growth within the UK. It effectively sells existing products to existing markets, the safest kind of business model, and has achieved significant growth in the past decade. More generally, the business, which focuses on sourcing and selling products more than manufacturing, is relatively capital light. What is even better is that it also has a duplicate model in South Africa. The group, which has a long history of selling in South Africa, also plans to generate 50% of its sales from overseas by 2025. Currently, the split is 65 versus 35 between the UK and South Africa. Particularly, the company reinvests heavily into its business, retaining 65% of its profits and at a high rate of return, 15%. Unsurprisingly, this has led to impressive earnings growth. Third, the management team is alert, having plenty of experience and a very strong relationship with suppliers. In the fiscal year 2021, the company engaged public attention for the first time when the latest financial report came out. The underlying operating profit increased by 23% amidst the supply chain disruptions. This is truly rare, as most businesses are suffering from nearshoring markups. In an interview with the CEO, Nick Castle, he confirmed that the company was able to pass on the cost pressures during the COVID pandemic, primarily from China. This results from strong relationships with suppliers. Therefore, the company even benefited from increased availability and reduced costs of sea containers. The management team has made aggressive yet forcing efforts in acquisitions. The company acquired Merlin, the number one supplier of shower enclosures in the UK and Ireland, in 2017, using £60 million, and is on the way to achieving the growth predictions. In May, the company acquired the wall coverings company, Brent Westfield, by £80 million in cash. Grant Westfield makes laminate-covered wooden wall panels, a faster-growing subsection of the market than the ceramic tiles they already own. Other pluses also include joint development of products. The company owns a stable combination of leading brands, which should help it give some pricing power if the market gets too gnarly. The more famous brands such as Triton, Merlin, and Johnson Tiles are household names. The growth after acquiring Grant Westfield was not achieved by cost synergies, but by revenue making. Although the sector may be shrinking because of the stagflation, the management effectively increased the subsidiary's market share. As managed before, Grant Westfield's products are a faster growing subsection of the market than ceramic tiles. This shows again an active management that is working. Again, as in valuation, looking at the stock prices, enterprise value to forecast sales can be a very useful valuation measure for companies with cyclical businesses that look in danger of swinging profitability. During the depths of the 2008 financial crisis, this valuation ratio plunged to 0.32%, 0.32 times for Norcros, compared with the current rating of 0.46%. However, are times really going to get so bad in the recession that many expect to soon be upon us, as they were in a real estate-focused downturn of the global financial crisis? From a far more recent perspective, the valuation of the shares is in the bottom 15% of a 5-year valuation range. Coupled with the low debt levels, this is certainly attention-grabbing. It is therefore my recommendation to buy Norcros. Thank you.
Thank you very much indeed, Rachel. So, Stephen, let's go straight to you.
Thank you, Rachel. Fascinating. Didn't appreciate they've got a tap called the Knurled Fusion, which apparently is assertive, striking, and dramatic. So I've never met an assertive tap until today. So thank you for introducing me to the Knurled Fusion. Really good point on EV to sales. I was getting very similar figures. The average rating has been 0.55 times since 2008. On the acquisition, you mentioned it's a faster growing market. What about the price that they paid for the acquisition? Do you have a view on that? Certainly looked expensive relative to their own rating, albeit with a far higher margin profile.
Yes, I think they did pay like a quite expensive price for this company, especially since the economy is not doing so well. But I think based on their track record, acquiring like Triton and Merlin, I think, as I said, it does have like long-term growth potential, and in the longer term, it may like generate returns on that. But currently, I agree that it's like quite expensive price to pay.
And it was just the only on the debt side, you feel the low debt. I think that was excluding the debt load they've taken on to fund this acquisition. The latest net debt looked like £49 million, which is closer to 0.8 to 1 times EBITDA, which looks okay, entirely serviceable. In 2008, their operating profit fell 59%. I'm inclined to agree with you. We're probably not going to go through an 2008 experience, but this is a very highly operationally geared business. 0.8 times net debt EBITDA. Do you think, again, the timing of that acquisition, maybe it's a little bit unfavorable, but are you comfortable with that debt load going into a potential downturn?
I think it is quite a risky number, but considering that, I think it very much depends on the economic conditions, right? So if it is going, like the whole market is going down, it's a more risky figure. But if it doesn't get so bad, and since they're already increasing their share of the market and the economy will rebound, I think I'll be more comfortable with the number.
Judith, Andy, who wants to go next?
Ladies first, Andy, you go.
Okay, honestly, I've missed that Scottish humour, Judith. So I was quite interested, just looking back, it's quite interesting. Before 2022, this company had sort of 3 flat years in terms of profitability. And you don't feel they've just got lucky with the pent-up savings as a result of COVID, that everyone suddenly decided that they need a new bathroom, they're redoing their house. And it's just a very much one-off thing, which is, as we've seen with other stocks like sofa companies, is now going to unwind. And it's going to take quite a long time to get back into growth.
Yes, I agree. It does definitely has some cyclical factor building into it. But I think in the defense of the stock, I think it has a pretty good business model and it's operating quite well. So although I think for investment, it may take like a much longer investment horizon for sure, for like the economy will bounce back and like everyone will start purchasing again. And yeah, definitely has that factor. So but I went into like pitching the stock thinking we're investing in like quite long term. So yeah, that's my thinking.
And the other point, I like the way you highlighted the stock number and tied it all in with the debt. I thought it was excellent. But the thing that struck me, and I know we've got, my house, every tap seems to be leaking, dripping, but the provision is like 10% of the stock level. It just seemed a large number to me.
I think it is a relatively higher value. I'm to be very honest, I'm not very sure on that front.
Okay, well, no, honestly is the best policy.
Thanks very much, Andy. So Judith, questions?
So we've covered tax accounting, I think, in today, which is pretty much as good as pension fund accounting. Is there anything? How are you looking at the pension fund? Because although there's an accounting surplus, there's a actuarial deficit, and it's quite a big elephant in the room. I think it's about £38 million. And if you look at buyout values at the moment, well, actually very difficult to look at them at the moment with the gilts running around like they are just at the moment. But how would you put that into your valuation? Some people put it in as debt. Some people look at what a buyout value might be. Others just ignore it and then look at what the long-term payments are. How did you think about it?
I think I did not take into the consideration of this because from my perspective, we're quite investing like long term. I think from my perspective, it's about like how they're operating more. So
yeah, I think I've known this business for a while actually, and I really like its niche and its moat, and it's got great brands. I think one of the reasons that it's traded quite cheaply over the years is because of some of the deficit issues, the pension deficit issues and the debt. So, it's something that I would probably look at. I don't know the answer to this, but they do spend about £10 million a year on development costs. And, just thinking about it, I don't know how they changed those development costs going through more tougher times. When you look back in 2008 in the GFC, did you see that they changed that at all? Was that a lever that they had to preserve cash?
Yeah, I think so. But I think for like development costs, the return on like capital is quite high. So I think, it's like up to like 15%. So I think from that point of view, it's okay. I'm not sure about the 2008 financial crisis thing.
Yeah, I guess it's whether they pull back too much and then don't get that return on investment coming through, or it's just that happy medium, isn't it, that they have to try and gauge what's happening in the macro, which I think will be difficult over the next 12 months or so. I'm not buying any, is it grinder taps that you talked about there, Stephen? What was it?
It's the knurled fusion.
Oh, knurled, right, sorry.
Knurled fusion, yeah. And they've got the Linda Barker waterproof panel collection as well.
I think I'm just about to go online. That was great.
Tremendous.
Thanks, Rachel.
Judith, why don't we stick with you and you can give your views on the stock and on the pitch?
I inherently like the stock because it's been around for a number of years. It's a real steady eddy. As I say, that the debt and the pension deficit, question mark over that, put me off it over the last few years. But they have just gone through their triennial valuation on the pension deficit. I like how they've earned through the last couple of years, but I think they have been a COVID beneficiary. I would be slightly cautious about the headwinds. Good old Top Tiles profit warned the other day, which gives you an idea as to how the consumer's feeling about some of these larger ticket spends like new kitchens and bathrooms. The presentation I thought was good, really nicely succinct. I liked how you at the start you addressed the three main points, and those were the points that I think we were all probably wanting to cover off in our questions. So you addressed that first up, and I think your analysis on the numbers was pretty good as well. So yeah, nicely done.
Fantastic, thank you very much. And Stephen, what was your view on the stock and the pitch?
I think buying at these sorts of levels, there's a good probability you're going to make money on a 3 to 5 year basis, but the direction of travel is everything in between times. I'd be nervous. It is so operationally geared. The timing of that acquisition, was it wise? Don't know. I mean, the timing of the original float was July 2007. So a genius got this away. Then it collapsed 95%. Thereafter, the net debt though then was 45 million, and the EBITDA got chopped in half, and it came in at 7 million. So, and they had to do a rescue rights issue about a year later, and then they've done a share consolidation since. So this is inherently a cyclical business. That means you've always got to be still standing on the other side. I'm sure they will be, but I just would have taken a bit more comfort with a stronger balance sheet at this point in the cycle, albeit I think the acquisition they've made and the heritage and the brands that they've acquired is very, very good. Agree with Judith on the pension fund. They have signed off nearly £4 million a year now, top-ups for the next several years. That's free cash flow that's being diverted, albeit on an IAS basis, it's gone to a surplus, but I appreciate that's a bit easier from an accounting point of view than a triennial. So yeah, there's bull and bear points with this one. It's just the wider cycle that have put me off, but it's starting to look interesting.
And the pitch?
The pitch itself, I thought you covered pretty much everything. What I especially liked was you viewing it through the eyes of a customer. I do that exact thing myself. If they're not selling the wares well online, and then all the various touch points you can access as a customer, it can be symptomatic that they're just not very joined up from a sales approach and communicating that. So to think like a customer, I thought was excellent. It's kind of investment 101, and to get across the strength of the brands as well, because that's a key part of this investment case, that heritage. They'll still be trading around in the next few decades, no doubt.
Andy, we'll come to you and your comments on the stock and on the pitch.
Well, as a former accountant, I always like to see people going through the balance sheet and pulling out various items. So hats off for that. And I thought, I enjoyed the pitch. Like the other two, I think we've all been scarred with Norcros, and it's interesting to see that the last placing for the acquisition was at 230p. So the new shareholders have only lost 20% of their money. To me, it's the management team that whoever's been running it has seemed to snatch defeat from the jaws of victory on a regular basis. So while it looks cheap, I think there's probably better ideas in the sector. But hats off to your presentation.
Thank you very much indeed. So the moment we've all been waiting for, to hear the scores. So we'll run through this in the same order as the presentations were given. So we'll take Ralph's pitch first, which was for CPP. And Andy, do you want to give your score for the stock out of 5 and then the pitch out of 5?
Right. So the stock, I've gone for 3.5, and the pitch, I've gone for 4. So a total of 7.5 to help your maths, Tamsin.
I wasn't even going to give the sum of those at this point, but thank you. Stephen, what do you give for Ralph on his pitch for CPP and for the stock? Give me the stock first.
The stock, a 0, unfortunately. It's just uninvestable until we get that strategic review out. I've got no idea what the business is going to look like, and the cost of exiting that legacy business in particular. And the dividend's been scrapped as well.
And for the pitch?
For the pitch, 3.5. I thought you did well, Ralph. Yeah, you covered a lot. And just to take that stock on, you could have gone for something a lot easier. You didn't make your life easy at all. And in someone else's hands, it would have been baffling, but you did bring some clarity to what they actually do and serve up.
Tremendous. Thank you very much. And Judith, your scores for the stock and then the pitch.
Yeah, I kind of feel the same way as Stephen about it. I find it difficult to award much for a stock that is still in so much transition. So it's a 1 from me. It's not a 0, so that's better than 0. Presentation, yeah, I think you probably found one of the most difficult stocks in the small cap space to take on. So well done on hunting that one out. And so for that, you get credit. And for me, you've got 3.5.
So let's move on to Kai, who pitched Vector Capital. Stephen, your score for the stock and for the pitch.
Okay, just dumbfounded 1 is more than 0. Thank you, Judith. Is that what took you so long? Pitch 4. It was very, very comprehensive. There's not too many moving parts with a lender, but what needs to be covered, the absolute minimums were all there as far as I was concerned, mostly, except for return on equity. But the stock itself, I struggle with lenders. Like Andy said, it's easy to lose money on a small lender, so 1 for the stock.
Thank you very much indeed. And Andy, your score for the stock and your score for the pitch.
Well, yeah, I'm going to go 1 as well, because I just feel that actually, if interest rates are going up, I think this company is really going to struggle, and I just fear that lending long and borrowing short could well come back to haunt them. And for the pitch, I'll go for 3. I think you covered the points, but as I said in my summary, I think you just need to bring it to life a bit more. And that's something to, whoever you're pitching to or talking to, I think you can take that on board, really.
And Judith, for the stock and for the pitch.
Yeah, I mean, I'm not a fan of companies like this in the market, but at the same time, I've got to acknowledge that, they do have decent margins, and it feels like a family-run business. So 1.5, because that's more than 1, Stephen. And probably for the pitch 4, again, quite a difficult stock to take on, but I think you get credit for going to find something that none of us actually knew about in the first instance, and finding and describing a business that isn't actually, or a type of business that's not that popular in the stock market. So yeah, well done.
So finally, Rachel. Andy, do you want to kick off for Rachel? Both your score on the stock and on the pitch.
Yeah, on the stock, I think, I'll go for like 2.5. It's not one I own. It's probably not one I'm going to rush out to buy until I've got a lot more confidence in the management team that they're executing correctly this time. As I said, I thought the presentation was fast flowing. I thought you covered a lot of points. You'd obviously done a lot of work. And so I'll give you 3.5 for that, and 2.5 for the stock.
Tremendous. Thank you very much. And Judith, we'll go to you.
Of all of them, I think there's probably a stock that I might buy at the right time. Not that you want to try and time markets at the moment, but so therefore I would give it a 2.5. And the presentation, as Andy says, nice and succinct, address the main points, like the scuttlebucking that went on in terms of going to look for what's actually happening with products in the market. So I would give the presentation a 4.
Tremendous. Thank you very much. And Stephen.
Start with the stock. 2.5. I think the same as you, Judith. Definitely longer term and medium term attractions. Just wary. Valuations starting to get there. If it was another 30p lower, I'd be a lot more interested. And on the pitch, 4, give a 4 for that. I think really like the return on capital employed. You mentioned that a couple of times as part of their strategic target, and spot on getting the EV to sales ratio in there as well for a cyclical, very, very relevant metric.
Tremendous. Thank you very much. So that means that we have a winner. And I haven't told anyone what the prize for winning this is, which Andy Brough has very kindly offered to give you a day at Schroders. So you can see the day in the life of a fund manager. So who has won that? In third place is Kai, who scored 3.5 for the stock and 11 for the actual pitch. So well done, Kai. And in second place is Ralph, who got 4.5 for the stock and 11 for the pitch. Well done, Ralph. And finally, in top place, Rachel, you have taken the top prize with 19, having won 7.5 for the stock and 11.5 for the pitch, which was the highest on both, actually. So congratulations, Rachel. You will go for a day with Andy Brough at Schroders. So we'll set that up for you, and you can see the day in the life of a fund manager, and you can pick his brains on how he picks the winning stocks, although he won't be quite so pleased at Stephen's score for CPP. Huge congratulations, Rachel. That's absolutely superb. And Kai and Ralph, well done. Very good pitches, and thank you very, very much indeed, all three of you, for the work that you've put into this, because I know it's really time consuming, and it really showed that you had put a lot of care and attention into it. And even more, I should thank you for coming along to the first university challenge, because it's been the first time that we've had undergraduates doing this, and I have to say, I think you've all done an amazing job. So thank you very, very much indeed. And of course, thank you as always to Andy Brough, without whom this would not have happened. Judith, thank you very much indeed. And Stephen, thank you. It's been another great Sell It to the City. And to all our listeners, if you're an undergraduate fascinated by business in the stock market, please get in touch to pitch a stock. We'd love to hear from you. Just email via the contact page at piworld.co.uk. Or if you know anyone that might be interested or just as interested in investing, do send the video on to them. Many thanks for joining us, and good luck in your investing during these volatile times. See you next time.